Great. Can I welcome members, officers and the public here in the chamber or watching on the webcast to today's meeting of the audit panel. Just to make sure your electronic devices are switched off or to silent mode to avoid unnecessary interruptions. And if I could start by asking our clerk, Jada Hopwood-Cummings, if any apologies have been received.
Thank you, Chairman. Apologies have been received from Assembly Member Fortune, for whom Assembly Member Rogers is substituting.
Thank you. Welcome, Assembly Member Rogers. Before we begin, I'd just like to welcome all of our guests who will be joining us at various parts of today's meeting, some in the chamber, some remotely. So we have Chloe Wilkinson from EY, who I believe is observing. We have, who is in the room. We have Rita Cherkop, who is Senior Program Manager, Skills and Employment at the GLA, who is joining us virtually. We have Stuart Scott, Senior Program Manager at the GLA, who is joining us virtually. We have Peter Rollinson, Counter Fraud Manager at MOPAC, who is joining us virtually. We have Emma Strain, the Monitoring Officer, who will be joining us in person. We have David Galley, the Executive Director of Resources of the GLA, who's in person. David Esling, Head of Audit and Assurance at GLA, who's here in person. Karen Welsh, Senior Risk and Assurance Manager at GLA, who is joining us virtually. Mark Woodley, who is the Group Audit Lead of MOPAC, who is here in person. And Jerry Murphy, Deputy Chief Executive LLDC, who is here in person. And Anthony Britton, who is a partner at EY, our external auditors, who is joining us remotely. I'm looking at our remote joiners, and that looks like a healthy crop of people. So welcome everyone to the audit panel meeting. So rattling through our initial items, we have declarations of interest. Can I ask the panel to note the recommendations set out at item 2 and ask members if they have any interest to declare? Excellent. Nothing to declare. Item 3, minutes. Can I ask the panel to confirm the minutes of the meeting held on the 15th of December as to be signed off by me as a correct record? Agreed. Excellent. And item 4, summary list of actions. Can I ask members to note the completed and outstanding actions arising from previous meetings of the audit panel? Excellent. So item 5, our first substantive item, a Q&A session with invited guests on the London Legacy Development Corporation. And we are joined by Jerry Murphy, who's the Deputy Chief Executive of LLDC, by David Galley, who is the Executive Director of Resources at the GLA, and Andrew Britton, who's a partner at EY. Welcome, one and all. So who would like to present sort of initial remarks? David.
And perhaps Jerry could give a sort of overview of LLDC's financial position overall and position on the accounts.
I can do, yes, obviously.
Oh, sorry, could you just press the little button on your mic so it goes red and we can hear you? Perfect, thank you.
Okay, thank you. We presented the annual budget at the Budget and Performance Committee prior to December, and that's now gone through our board. In terms of LLDC borrowings, we are within our borrowings limit for the next 4 years. The position is not without risk. We've absorbed an increase in East Bank costs through other upsides in the model. We remain in surplus for the repayment of borrowings, but there are obvious risks to that. We're in a kind of softening development market, and there are superinflation pressures. As well as regulatory pressures now in the form of fire regulations or net carbon. In terms of revenue, we presented a balanced budget, but that included support from the GLA in relation to inflation largely, but not wholly, on utilities. Really significant increase in utility costs in the stadium. We are mitigating that. We're coming to the end of a long-term investment in LED lighting, so we're hoping to see reductions in consumption on a 2019 baseline of 18% next year. So while that won't absorb all of the increases, we're hoping it will absorb some. Also, we're now currently looking at pricing for next year, and actually the prices are a bit better, so that shouldn't be as significant. We are reliant on commercial income in next year's budget and the following few years, and that has been difficult for us and represents a significant risk. Unless there's any other questions, I wasn't going to go through all of the budget.
No, that's fine. Just
Flavour,
a flavour, yes.
A flavour. In terms of this year's accounts, so sadly our accounts are not yet finalised. I would say in August of last year we were on the home straight. However, EY wanted to look further at two areas in particular. One, investment properties, and the other, the onerous contracts provision in the E20 accounts that relates to the contracts with West Ham and UK Athletics. It has been a really tough old process, taken up a huge amount of our time. They're both technical areas, so in terms of LLDC, investment properties, you've got venues and park, we've got a number of development plots, and we also have East Bank, and they all have attracted their own technical challenges. The work's been extensive for the team. I don't think my team, I feel I must say this, I don't think my team could have done more to get us to where we are, but sadly it's still not over the line. There's been extensive work on investment properties. We've had to go back as far back as 2016-17. There'll be extensive re-presentation in the accounts. There'll be prior adjustments, and there'll also be some of the income that we had previously recognised in relation to East Bank will now be deferred. So our accounts are going to have significant disclosure. EY are still looking at those numbers, I understand. In terms of, but we are hoping, that the LLDC accounts will be concluded in April. In terms of the E20 onerous contracts provision, we've carried a 200 million provision in the book since 2016-17, and that has been revisited in part because of a change in the standard that deals with onerous contracts and contingent liabilities. So that onerous contract provision ultimately has been reworked, the scope has changed, and also the discounting rate has changed. Again, it's been a very iterative process, but we are now hoping that the numbers for the E20 accounts and the accounts themselves are ready to be, or will be ready to be signed by the end of March. And of course, E20 accounts has a company's house deadline. We got an extension to March, so the end of March is really our very hard deadline. I would say in relation to these adjustments, and they are extensive, these are technical accounting adjustments. There's no underlying change to the economics of the stadium business or to our development returns, if you like. So these are much more accounting than any kind of change in fundamentals of the business.
More technical than substantive?
Yes.
Okay. You mentioned on the deadline, you mentioned that there was an extension from Companies House until the end of March, but then you also said April?
Well, the deadlines in relation to the LLDC accounts are actually set by, I'm going to have to refer to David actually, they're set by SIPFA.
Maybe it's set from consultation.
And that's the deadline's the end of November, so we have missed that deadline. There are no penalties as such, but we have, and my team have taken a pride in getting over the line in reasonable time previously.
Yeah.
The Companies House deadline is a statutory deadline, and although they've given us a deferral until March, we would be subject to penalties thereafter.
So you're confident that you'll hit that deadline in March?
We are. I look to Andrew on the.
Okay. Because I suppose the concern I have is obviously we did talk about this, not you and I, but we, this panel spoke about this at our previous meeting, and we really only meet quarterly, so it's rare to have the same issue, obviously, rolling over. And I suppose the concern that's arisen, that particularly is a concern to me and I think others, is that this, you've spoken about the issue that's holding up the LLDC accounts from being approved, but of course LLDC is part of the GLA accounts, so my understanding is that this has also created a completely unnecessary, as far as the rest of the GLA is concerned, delay to the whole group accounts, the whole GLA family, I think we like to call it. So is that, I don't know whether you could answer that, David Galley. So is it, so the GLA accounts have been delayed for, what, 5 months or something because of this issue?
That's exactly right. I mean, just to go for more detail, I mean, effectively with Chloe, we were pretty much there to go well within the statutory deadline of the end of November. So the only thing that's held us up has been the issues arising from the LLDC, as you say, because it's part of the GLA's group accounts. So we can only go at the speed of how those are resolved. So we are subject to the same timelines and deadlines that Jerry's described. We have to wait for that process. Now, what we've obviously looked to work with Chloe and her colleagues on the GLA side is obviously to work in parallel, so that as and when Andrew and Jerry solve the issues as described, then at the same time my team can also work with Chloe and her team to ensure that we can do it as soon as possible. But I think in practical terms, I think we are probably looking at best probably for a sign-off in mid-April, I think, for the GLA accounts, even with the best will in the world and things working. The difficulty we have is because there's been a delay for the best part of, I guess, 6 months in reality. Things have obviously moved on, so there are new things that we had to absorb in our accounts to satisfy Chloe. So, for instance, on pension changes, which have come in late, which then require us to change the accounts that otherwise would have been approved in the autumn. So it has a whole knock-on effect. It has a knock-on effect also in terms of the planning for the 22-23 audit. So at the moment, the statutory position is that we are supposed to have draft accounts to EY by the end of May for 22-23 accounts. Now, there's just no way that is possible, not least of which we don't have an audit plan from the EY with levels of fees as we normally would have done. So it has a whole knock-on cascading effect. I guess the one sort of consolation is that very much we're not alone. This is a structural endemic problem across the whole of local authority accounts.
So I don't know whether Andrew Britton, who I believe is joining us remotely, because I suppose I'd just like to understand why it is that this apparently technical rather than substantive issue has obviously held up the entire ship of state, as it were, of the GLA group accounts. So I think it would be useful to understand something about that. I don't know if you're there. Can you hear us, Andy?
I am here. Can you hear me?
I can. Excellent. Thank you.
Good. Thank you. Thank you for the opportunity to explain. In terms of just reiterating the points that both Jerry and David have touched on there, this is a technical accounting matter which has taken a long time to resolve, partly because there were various iterations to it in terms of we looked into the primarily around the investment properties and the classification of the assets that make up the investment properties within the balance sheet, and then had to then compare them to the various different standards that could and should apply to those various different assets. So, for instance, looking at things in relation to investment properties or inventories, and therefore there is a different valuation approach applied to those. All of those, as Jerry has said, took a while in terms of iterations as the LLDC team worked through, and then obviously we considered the output that they had produced, provided comments on it, reworked issues that needed to be resolved. These are not straightforward assets that we're looking at. They are all individual in their nature and therefore need to be considered on an individual basis. That has, of course, then, as has already been highlighted by Jerry, identified or caused us to revisit the way they were classified in the previous year, and as said, that then needed to go back to, in some cases, 16-17 to unwind the transactions that had happened and revisit them under the new approach. So it's on that basis in terms of and wanting to make sure we get to the right answer, and bearing in mind that, of course, when we are looking at these types of technical issues, it triggers various review processes, both in the preparation and, of course, in the audit of these numbers that has taken the time. I think from an assurance perspective, clearly the key here is to make sure we get to the right answer in terms of management's preparation of the accounts and our audit of them.
Can I ask though, because in all of those, you mentioned going back sort of half a dozen years of, unpicking and redoing. I mean, these are the same, unique and unusual assets that were there then that are here now. So what is it that triggered the change for this year?
So it's previously the investment property balance within LLDC had been considered on if you like, a one-site approach in terms of viewing them as a whole and valuing them as a whole. The technical challenge in terms of that we were grappling with here was actually reconsidering, when you break down what the component parts of that are, whether they should and could be valued on a different basis, i.e. they should be classified differently and therefore valued differently.
So that was something that you flagged up, was it, with the way that it was being done before, that you weren't happy with?
So we were, and I think Jerry mentioned this, we were subject to an external review, which raised the question as to whether there were in fact different methods of classification within the balance, and we therefore took further steps to look into that in more detail, and concluded, whilst in some instances the assets there were appropriately classified within investment properties, there were some, so for instance the residential developments, once they reached a state of development, and the East Bank, as previously mentioned, which needed to be reclassified to elsewhere in the balance sheet. Okay,
so just to sort of wrap that discussion up, I don't know if anyone else has any questions on that, but from my point of view then, so you're happy that this date that's been talked about of the middle of April to get all of this done and dusted and signed off and able to move on to the next year, you feel confident that we can hit that deadline?
So certainly from an LLDC perspective, what we've talked with Jerry, Richard and the team at LLDC is about clearing the residual matters that we need to by the first half of April, and so therefore that would then put us in a position to sign off at an LLDC level, yes. Okay,
I'll take that as a hopeful, optimistic yes, but I take your point that you can't say yes for definite until it's all done and dusted. Did anybody else have any other questions on the LLDC point? Because I had another couple of questions, but I'm conscious that no one else has spoken yet.
Just a brief question.
Sure.
So just looking briefly at the 2017 internal audit review, and really kind of a process question, is there a follow-up review that is due to take place, and are those regularly spaced? So is 6 years a normal timescale for reviews? So who wants to take that?
So we're bringing an audit plan here today, and it's a risk-based approach. So at that time, that review was requested by the then Executive Director of Resources, and looking at the process in place. So if you look at the follow-up to that, it covered all the areas that we wish to do. I mean, it is something, when we come to our audit plan for this year, if you felt that maybe that needed to be looking at again, then we could certainly factor that in. However, that review covered the key elements that we were looking at on the GLA perspective of the oversight of LLDC. And at this moment, on the risk side, risk-based approach that we undertake, we wouldn't necessarily anticipate undertaking a review unless, as I say, that profile changed. I mean, I might defer to David on this if he felt that was it. But I mean, our discussions have so far not demonstrated that was a requirement. So.
I mean, Nick, I think it's a really good question. The 2017 review is very much kind of out of date. It's talking about structures that have moved on in terms of the ownership of E20, etc., etc. And given as Jerry's described, the level of risk that we, the GLA, are underwriting of LLDC, then it would feel right that you consider adding it into the audit plan and perhaps displacing something else. I mean, given the scale of importance, the scale of borrowing that we're undertaking for LLDC, the risks that still remain, I mean, it clearly is an issue. From a governance point of view, obviously happy for that to be looked at as well. But I guess the issues, I think, to consider are perhaps more ones around the financial modelling that we've done with LLDC, the risks of that would be something, but obviously happy to sort of sketch something out.
Thanks for the clarification, and back to you, Chair. Interloped on your committee and added to your workload, so there you go.
Excellent. Thank you very much, Assembly Member Rogers. I was just going to ask about, obviously, the big change that's coming up is the sort of the dissolving or dissolution or whatever of the planning powers back to the boroughs. What implication that has in terms of the sort of governance and oversight? Because obviously that's a change to the role of LLDC, isn't it? Well, I don't know whether that's well, I suppose it's a question for you, David, actually, really, isn't it? How you're viewing the governance arrangements of LLDC. You're happy that they're fine with that change of role?
I mean, Jerry's probably a better place to talk about the how it's going to work with the new relations with the boroughs. But I think from the GLA's perspective, it's very much envisaging a smaller MDC, albeit what we've looked to do is keep the legal structure the same, because to actually sort of change it all would create unnecessary levels of work. So it is around transitioning to a smaller MDC. I think it's also around, as part of that opportunity then, to look at greater use of shared services where, Jerry and her team will still require some form of, finance support, HR support, IT support, and so a lot of work we're doing as part of the group-wide collaboration to bring LLDC more into that. I think the issue is also, ultimately, we're looking, the aspiration we have is very much for the reduced MDC to be able to wash its face at some point in the mid-2030s, and there's clearly a lot of work still to be done on looking at that. How can we achieve that? And that's something that we'll obviously bring forward as part of the normal budget deliberations over the next few months and years. It's clearly a difficult process given the level of present contribution that the GLA makes, albeit, of course, it's important to recognise that the overall area, of course, is generating very large sums of business rates and council tax, albeit, a lot of that goes to Newham and the other boroughs rather than necessarily directly to the GLA, but we get a good cut of that. So I think it's around ensuring from a GLA perspective that the MDC is getting to that point where it can be self-sufficient, if you like, from income source. But obviously that raises a whole set of issues and questions around, the fixed estate charge within the area, etc. So there's a whole set of very difficult, complex issues that we need to run through.
Okay, thank you, David. Jerry, what are your views on how the particular, I suppose, particularly the governance looks? Views on how the particular, I suppose, particularly the governance looks from the new era of LLDC.
I think so. From the 1st of December, LLDC will lose planning powers, but also East Bank will be concluded, and by the time we get into 24-25, April 2025, we would hope to have all of our development sites under contract. So that's what we're doing now at the moment. We're out for a joint venture partner for PML. We're out for a development partner for Rick Roberts Way. So at that point, I think, as David said, we can thin down, but there's still a lot to deliver. So there's still the park and the venues. There is still the focus on inward investment and inclusive economy. And there is also, of course, until the mid to late 2030s, a lot of development going on. So although the organisation will be smaller and there will be fewer boards and committees, I think probably the GLA oversight would still, the GLA would still want to ensure that it's got sufficient oversight of those activities. As David said, there's a lot of focus now on financial sustainability. In 25-26, this year's budget produced the first numbers for that, and that shows, setting aside the stadium, a 40% decrease in GLA grant. but the risks are still there. That depends to some extent on commercial income. So we are very focused on hitting that target that LLDC will be financially sustainable in terms of its revenue funding, day-to-day revenue funding by the mid-2030s.
Great.
At that point, of course, as David also mentioned, the fixed estate charge will have grown to its maximum bar inflation. So that is the plan, but it's a work in progress.
Yes. Well, I know we did have a plenary last week, so obviously some of those types of issues were explored in some detail, it would be fair to say. So I don't think I had any further questions on this. Did anybody else? In that case, I think thank you very much, Jerry, and also Andrew, who I think were joining us remotely just for this item. So you are free to go about your day. Thank you very much for your time. So we will thank our guests for attending this part of the meeting. And can I ask the panel to note the report and the discussion?
Noted.
And delegate authority to me as chairman in consultation with the deputy chairman and party group lead members to agree any output from the discussion.
Agreed.
Excellent. Okay, well, thank you very much. If we move on to item 6, which is a series of internal audit reports. So Appendix 7 to this item concerning an investigation into suspected theft of IT equipment has been provided to members only as an exempt item and reserved from publication. Should members wish to discuss the content of this report, we may need to resolve to exclude the press and public from the meeting, and I would suggest that we do that if people wish to do that at the end of the meeting. So we would cover all of the other items first and then return to that item. But my intuition is that we may not need to do that, and we may be able to discuss that item to the extent that we need to just in a public session, which would be my preference, so that the public are aware of what is going on. Let's see, the first item is where are we? So David Esling. Okay. Yes, Head of Audit and Assurance, and Mark Woodley, Group Audit Lead from MOPAC. If you would like to go through each of those reports in turn, as we normally do.
Thank you, Chair. So I'll just introduce the progress report, and then, as you've described, then Mark will take over going into the detail of the reports that we've brought to today's panel. Work summarised from 1st of December to the end of February. We're bringing the following reports, as I say, that Mark will take us through, which was the closure of the European funds and transition to the UK Shared Prosperity Fund, the review of ethics and accountability. We've touched on the investigation, and I will touch on that slightly in a second, and then the follow-up reports of audit payments approval process, and also the follow-up of the audit of loans. Just to give a current status of work that from this year's plans, we've got a draft report currently with management on the group collaboration programme, and that's a follow-up, and also the issue of reviews in HR policies and procedures. There's also the material financial systems of key controls, and these are underway and will be brought to the July committee. So those reports are currently in progress. There's also systems development work that's continued with the AEB, the Adult Education Budget work. This has included attendance at 6 weekly audit and assurance task and finish group meetings. And this continues our work with oversight of the AEB from an internal audit and control perspective. And then there's also fieldwork underway on the advisory review on the migration of IT services to TfL from GLA. I will also talk through the 23-24 GLA audit plan and take in obviously some of the points that have already been raised, in particular on the LLDC point. I will just touch on the counter-fraud work that we have completed in this quarter. So work has continued on the National Fraud Initiative, and there have been matches identified, and those are currently being worked through by our counter-fraud team along with GLA staff. And then the update of the outcome of each of these matches will be brought once that work is completed. I anticipate that probably July's committee. David chaired an anti-fraud workshop with members of the GLA families. We were looking at fraud and aspects of fraud that have been highlighted recently, and we've been dealing with from an internal audit perspective. I think it was quite a productive meeting, and again, the outcome of that meeting and those discussions, I think, will be brought along to a few future panels. And there's also, we've been working with the NFI and London Borough's Fraud Investigators Group, and that's continuing to progress on this agency worker pilot. So this is working with, in a particular issue that obviously the GLA have experienced, and other members of the GLA family, but also London Boroughs, where there's the new dynamic, I suppose, of working from home seems to have allowed individuals to have more than one role, and obviously that's created a fraud outcome, of which we've unfortunately been involved in a number of investigations from that perspective. And touching on the report that you mentioned, so there was we were notified by the technology group of some some missing Surface Pros from Union Street, the TG build room. So we undertook an investigation of that, and that's been concluded. And that report is obviously, the panel have that, and if they wish to take that in at the exempt session. So that's everything from my perspective. I will now pass to Mark to take us through the substantive audit reviews, I think starting with the review of the closure of the European funds account.
Before we move on, I was just interested in the point you were making about the sort of conference, the discussion about fraud, and particularly, changing patterns. Whenever you get new phenomenon in the world, you get new opportunities for ne'er-do-wells to,
take opportunity.
Yes. So what are the patterns that are emerging in terms of perhaps some risks that is diminishing and other risks that are emerging?
So, the first one is the one we've just spoken about. Is obviously the agency workers. I might actually ask Peter, who's here, who's done as counter fraud manager, who's doing some exceptional work on these counter fraud things. So I don't know if Peter's online. Might want to touch on that, because he'd probably give you a better overview of the work that he's been particularly involved with.
If Peter is there, I believe I can see him online. Are you there, Peter?
Here he is.
Okay, yeah, I'm here.
Thank you.
Yeah. So what we've found across the public sector is it's certainly there was always a chance that traditionally permanent employees would be working for two public sector organisations, and that is one of the things which led to the creation of the National Fraud Initiative. So we would identify that. What's been particularly prevalent, and it started during lockdown, was affecting the GLA family, were accountancy professionals and qualified accountants working for a number of clients at the same time, and this not being identified unless by chance. And sort of having found it by chance, there's a realisation that they haven't actually been working the hours they've been billing for, and there's been poor quality or work not done in certain areas. So these have been reported to Action Fraud. Most of them have not been forwarded by Action Fraud. One was forwarded by Action Fraud to the police, who declined to investigate it. It wasn't a South East police force, it was elsewhere. So we've been working very much with London Borough Fraud Investigators Group and the National Fraud Initiative Cabinet Office staff to pilot matching agency workers' payrolls, agency supplier payrolls across the London boroughs and GLA Group, to identify duplicate or triplicate or even more placements, some of which may be perfectly okay, but we will be using the tried and tested NFI secure way of doing this and the methods we use for that. We've got experience of it, and we will be sort of following that through. And at the moment, we're in discussions with the agencies to do this in a way that they're content. But NFI have put it through their governance framework, and they've passed it, and they see no sort of obstruction to doing this work. And it's probably going to be in the summer this year that the pilot will be done. If it's successful, they may roll it out into the national biennial NFI.
Thank you. That's quite useful, Peter. It's a bit disappointing to hear that we are perhaps among the long list of people who reported fraud incidents to the police and not had the snap to it response we might have liked. But I'm quite pleased to hear that we're sort of systematically trying to squeeze out the possibility by trying to cross-reference. But I appreciate the difficulty that if someone is working in a consultant capacity, they might legitimately be doing that at different times, you know, over a split week.
I think it's fair to say, Chair, that so Peter's coming from a counter-fraud perspective. From an internal audit perspective, this data matching is very key and critical to identifying this, but also some fundamental sort of internal audit controls, like just management and supervision. So although people are working remotely now, in the old days you might have somebody come into the office and you notice them if they're not there, if they are there now. It's that heightened, so it's an awareness of the management responsibilities and supervision, so that shift change really from remote working and what managers should be doing and looking at the outcome and output of those individuals that may flag up whether the work's being done. And we, as part of our terms of references, we always have a fraud element built into that. So as part of our key control work in all reviews, we would be looking at fraud elements, and obviously working with Peter and his team, we're feeding in those shift changes in fraudulent behaviour. So that's what we're doing there.
Well, I was just going to say, in terms of that change of sort of management approach, is that something that's now embedded or something that is in the process of being developed and embedded?
I think it's a shift change. It's always management and supervision's always been there. It's just that it's how people's who are undertaking the management supervision are looking at how they should be undertaking that now. So it's that check-in process. So, you know, some simplistic things that you may take for granted. As I say, when somebody used to walk through the door, now it's maybe a check-in, an online check-in, and just, you know, some basic changes really in behaviour from a management perspective to understand what the employee is doing and you know what the output is and delivery. So it's really just those sort of nuances, but actually they're quite key for identifying individuals. Certainly the cases that we've had to deal with, that if that had been done more effectively, that probably may have been picked up earlier, I think.
Okay, I suspect this might be something that becomes something that we look at more than once.
Yeah.
Did anyone else have any questions on this before we move on to the Shared Prosperity Fund? Shaking of heads. Okay, thank you for that. Mark, you, as you were 10 minutes ago, the Shared Prosperity Fund.
Okay, we reviewed the effectiveness of the control framework in place for the closure of European funds and transition to the UK Shared Prosperity Fund. A little bit of background. The UK Shared Prosperity Fund is a domestic replacement for the 7-year European Regional Development Fund and European Social Fund programmes, which will close in 23-24 with funding finishing in December 2023. We concluded there was a substantial assurance rating with one area for improvement identified which was accepted. Our findings were that European fund programmes have been reviewed and activities that will continue as part of the UK Shared Prosperity Funds have been identified. Workshops have been held with the GLA, between the GLA and stakeholders. A UK Shared Prosperity Fund investment plan was submitted to the UK Government and approved in December 2022. Services were identified and included in the investment plan, and objectives and outcomes have been identified for each scheme, and they've been clearly documented. Arrangements for the payment of funds are in the process of being implemented along with budgetary control processes. Monitoring arrangements have been established and arrangements for review are being implemented. Oversight of the Shared Prosperity Fund is in place through the London Recovery Board and the recently established local partnership subgroup. The one agreed action that we had referred to the fact that guidance around the monitoring and reporting of the UK Shared Prosperity Fund has been received from the UK Government. However, further guidance was expected on monitoring and evaluation, and this was due to be received in the autumn of 2022, but it's still awaited. The UK Government has also yet to share its reporting template with lead authorities, such as the GLA. As a result, the GLA have put in place monitoring review processes based on the guidance which has been published to date. Once all the UK Government guidance relating to the monitoring and evaluation of the Shared Prosperity Fund, including the reporting templates, is issued, The GLA will carry out a check to undertake to ensure that the monitoring processes established comply with the UK government guidance. So it's very much, they put these processes in place for now. Once they get the final guidance, they'll carry out a check just to make sure they're crossing all the correct areas.
Okay.
So that was it on that one.
Thank you very much, Mark. Did anyone have any questions on the Shared Prosperity Fund? Kripesh?
I did, but they'll be shorter because I think you answered it in your opening remarks about the guidance and monitoring. So I just wanted to get this sort of clear in terms of process and where you are, because you've got the schemes which this funding is in theory going into. Are you having ongoing conversations in terms of what could possibly be in that guidance? We don't want a situation where you're finding out that schemes and projects do not match what eventually comes out in guidance on monitoring and evaluation.
Okay, I think Rita and Stuart are online. They might be able to help with that question.
Yep, so we have now, I think as of a week ago, received or there has been an update to the monitoring and evaluation guidance. So that, I think what we expect to be sort of the fairly final position, unless revisions are made as the programme goes on into delivery. So we do have the guidance now. We have had a kind of initial review. There aren't a huge amount of sort of changes or updates. The guidance is sort of relatively, I guess, light touch if we compared it to what we had around structural funds. So I think there's a kind of good degree of confidence that what we've put in place so far doesn't need to be adapted too much or tweaked too much. But obviously we'll kind of keep that under review, and we are still sort of finalising our monitoring processes, particularly around, we have launched a call for proposals. Those are in, so we're just kind of finalising the sort of systems and processes that will operate and support that programme of activity.
Thank you. Thank you for the update as well. So obviously we've had a change since the papers were published and brought to our attention. So that's reassuring also to hear that it won't have an impact on, or it appears on your initial screening, it won't have an impact on the work that is undergoing in this area anyway. Also, maybe just a question for David Galley about sort of the level of funding that London has been awarded, because essentially it is much lower than the EU funding that it sought to replace. So in terms of the risk associated with what the GLA wants to deliver, what risks are associated with the ongoing activities of the GLA?
Well, essentially, we've had to cut our cloth to meet that lower level of funding, as you say. I mean, so that's now reflected in our GLA Mayor budget. It's obviously a lower level of activity than we've had previously. I guess that's the nature of external funding, where you have to live within that quantum. I don't know whether Stuart or Rita might want to add a bit more to that.
Yeah, I mean, I think that is so. It's yes, it's disappointing. It's probably around kind of half what we've had through structural funds. The time frame is obviously shorter in terms of kind of the 3-year delivery period, but I think even taking account of that, it's a much sort of reduced allocation. So I think it's been a kind of process of prioritising and looking to invest funding where there is the kind of the biggest gaps, the greatest need. So that's obviously for the people and skills strand, something that we've sort of identified the priorities at a high level, but now more detailed work will go on to kind of look at where the real need is and how we can add value to things like the skills funding. Obviously there's a significant amount of AEB, so it's really about how we kind of target this UK SPF funding and make best use of that.
And just from a sort of practical working perspective, so in terms of the issue, well, maybe joining the two issues that I've already raised together in a way about how this process on the Shared Prosperity Fund has worked in terms of the guidance coming out much later than was expected. Autumn 2022, I think it said in the paper, was the expected date. How has that meant that you've had to adapt in terms of working environment? Was it something that would readily also happen under the previous ESF arrangements as well? Would you, or would you have expected all the guidance to come out along with the funding announcements in the first place?
I think given so I suppose the draft guidance was in place at the time, and I think that the prospectus was published, although Stuart, you might correct me if I'm wrong. So that there was some guidance there, but it's I suppose it's been a fairly different process in that there is much more emphasis on the kind of legal authorities to pull together their own more detailed guidance and things like evidence requirements that I suppose previously we would have been able to sort of look to the managing authority for. So yes, it's meant kind of quite a lot of work going on at the same time, and I guess technically the funding should be in delivery already, so we have already kind of to some extent missed the first year of that of UK SPF funding. So yeah, it's a kind of challenge, but I think we've tried to kind of make sure that we can sort of plough ahead and, for example, kind of launch the call for proposals as soon as we got the green light from government and approval of our plan. But yeah, in an ideal world, the guidance and our plan would have been approved much earlier.
I will just add that we have, years of experience of managing the EU funds, and that is pretty heavy and bureaucratic, frankly. And so we had that experience to build on, and we knew from everything government was saying and from our colleagues across the country who we talked to that it was going to be slightly lighter touch for UK SPF. So we felt we were in quite a good position to develop our London UK SPF programme based on what we knew and what we'd learned. Hence why there haven't been any surprises with what they've published so far.
Thank you, and you raised a quite important point about your colleagues in other parts of the country as well, because obviously this isn't specific to London in terms of the process. We might have had a sort of difficult outcome in terms of the levels of funding coming into London, but in terms of process, I think it's something that everyone's had to battle with across the country. Are there any sort of joint lessons or learnings, or is there scope for the government to take feedback from yourselves in collaborations with other authorities to learn more from the process this time around, to see how improvements can be made in the future?
So the answer is yes, and a group of some of the larger, they're called lead authorities, will be convened. The first meeting is in early April. It's actually Cornwall Council's initiative. So the likes of us and Manchester and Liverpool and Birmingham, Cornwall, we will be getting together, and there will be representatives from the lead department for UK SPF, the Department for Levelling Up Housing and Communities, and we will be able to feed back to them. And as a group of lead authorities, we are very much singing from the same hymn sheet on the progress we've made over the last year since the announcement was first made about SPF last April. And we have very similar views about how it should be taken forward, including from a paperwork process and how do we make sure we spend the money in the next 2 years.
Okay, thank you very much. Does anyone else have any questions on that item? No? Okay, thank you very much. I look forward to hearing future success of how the money is being spent. So that takes us to the next item, the audit of the payments approval process. Is that you, Mark?
Yep, that's me. We reviewed the payments approval process in May 2022 and concluded an adequate assurance. 2 management actions were agreed to improve the management of the key risks identified, which had an agreed deadline of January 2023. We found that the overall control framework had improved, with since the original review, both the recommendations had been fully implemented. The 2 implemented recommendations were procurement guidelines have been reviewed and updated, and the procurement processes can be found on the GLA intranet site, which is accessed by all GLA officers. Monitoring review of single source requests and exemptions from the contracts and funding code has improved. The GLA government steering group now receives 2 reports from TfL procurement. The first report shows a list of all decision forms where exemptions had been requested and approved, and the second report relates to single source requests and contains detailed information related to GLA costs, the number and value of single source requests, the reasons for the single source requests, and single source requests made by each GLA directorate. The reasons for the single source requests were discussed at the governance steering group in January 2023, and further review will be undertaken with GLA directorates to identify whether insufficient notice being given to TfL procurement was due to factors outside of officers' control or the result of poor forward planning. So there were the two things. So the two actions had been implemented.
Yeah, I don't know that I had any questions on that, actually. It sounded positive. Anybody? Lots of nods, approval. Thank you very much. So if we move on to the draft GLA... No, I'm going too quickly. The audit of loans, I believe, is next.
Okay. Right. Follow-up of audit of loans. We reviewed GLA loans in July 2022 and concluded an adequate assurance. There was one agreed management action which had an agreed implementation deadline of September 2022. Since the original review, the agreed action has been partly implemented and the assurance rating as a result has remained as adequate. When options for a centralised loan system were researched by financial services, systems that were previously thought to be available had been withdrawn from the market and alternative options were found to be too expensive and not suitable. As a result, the loan spreadsheet has been reviewed and password protected now, and the password will be changed every 6 months by the systems accountant who does not use the spreadsheet, and passwords will only be issued to authorised staff. In addition, a series of additional actions will be taken by finance services on the spreadsheet. The spreadsheet cells which need to be locked will be identified so they can't be overwritten. The Assistant Director of Financial Services is going to receive monthly reconciliations of both capital and interest. The Assistant Director has also requested a complete redesign of the spreadsheet to put it into a better order. DARA have agreed that with the GLA that they will review the revised spreadsheet solution prior to implementation to ensure that the risks that were highlighted in the original audit have been mitigated. And finally, financial services will continue to explore alternative options for a loans management system.
Thank you. Yeah, I remember when we looked at this before. I was a bit surprised that such a key piece of information was stored in spreadsheets. So I'm pleased to see the spreadsheets are being controlled a bit better. But I mean, my question was going to be: are we looking at a proper piece of software? And it sounds like that is in the pipeline.
I mean, there are two bits of work I think is worth how we're taking that recommendation forward. The first is, you may be aware that we're actually, as part of the collaboration programme, we're now in a shared service with TfL, so that effectively the back office admin side, which is really where this is largely coming from, is going to move to TfL. At the same time, TfL's investments will come into GLA. So it's a win-win where we're kind of the strengths in both organisations are being optimised. So I think as part of that, the reshaping of the back office gives an opportunity, because TfL do have a very sophisticated, expensive loan system which we could potentially piggyback on. On top of that, was also a lot of work being done to update SAP as well, which also gives an opportunity to actually think around how do we solve this, because it's incredibly it's not a straightforward issue to solve, because there are so many users of that loan system with different needs. To actually have a bespoke system is probably what we need, which then tends to be very, very expensive. So work is very much ongoing, because the risk is obviously, as Mark's report sets out, is really quite potentially quite high.
Yeah.
But we are looking at both those two angles.
And you're happy in the meantime that this process of effectively keeping it in a spreadsheet, but having much more control over the change processes on that spreadsheet, that's adequate for the meantime?
I mean, it's adequate rather than ideal.
Great. Okay. Does anyone else have any questions on that item? Okay. So that does take us to the draft audit plan.
Chair, if it's okay with you, if Mark takes you through the ethics and accountability, and then we go to the GLA audit plan, just it seems to flow with the audit reports. I just think maybe better to approach it in that respect.
Oh yes, it's an unfortunate victim of where the page break is on my piece of paper. So. That's fine.
If that's okay, thank you.
Okay, ethics and accountability. We reviewed the guidance on ethical behaviour that is provided to GLA staff, and assess the guidance provided as part of the recruitment and induction process, as well as how corporate ethical requirements are communicated on a timely basis. We also looked at how ethical issues are monitored to identify lessons learned and reviewed the processes in place for incorporating these into future guidance. We concluded there was an adequate assurance rating. With 3 medium priority areas for improvement were identified, and all the recommendations and actions made were accepted. We found that there was an approved governance, accountability and risk management framework with clearly stated ethical policies, procedures, roles, responsibilities and standards, which were in line with the recognised best practice and national guidelines. An effective communication strategy across the GLA is in place to help promote, embed and disseminate expected ethical standards, values and behaviours. And management information is available and is used to identify and incorporate lessons learned and to inform decision-making, monitoring and review activity. The 3 areas of improvement that we identified were a number of the policies and guidance relating to ethics and accountability required updating to ensure they cover best practice and statutory requirements. It was agreed that periodic reviews are to be carried out of all policies and procedures in line with the planned review dates. Completion of the mandatory corporate e-governance e-learning module by staff requires some improvement, and new staff are required to complete the training as part of their induction, and existing staff should retake the training every 2 years. In October 2022, it's reported that 32% of GLA staff had completed the training. At present, training data is being migrated to the new platform as part of the HR shared service provision. And enforcement of non-compliance with mandatory training will be implemented once the migration to the training platform has been completed. Also, a subgroup of the governance steering group is to review the list of mandatory training and confirm which ones would be mandatory going forward, and a realistic expectation of compliance with recommendations on a revised list is going to be going to the April 2023 governance steering group for approval. Finally, although staff are reminded about the need to complete a declaration of interest, there's no formal process in place to ensure staff, aside from senior GLA staff, review their declaration of interest periodically. There is a need to strengthen the declaration of interest process by requiring staff to confirm their declaration of interests, including the introduction of a requirement for the submission of nil returns for staff with no interest to declare. As a result, a specific question on declarations of interest is to be added to the annual performance review template, and line managers will be prompted to ask staff if they have anything to declare. The manager can then either record that no declaration has been made on the performance review template, or ensure that the general notification of significant disclosable interest form is completed. New staff will be required to complete the declaration of interest as part of the induction process. Finally, although a declaration of interest is required for procurements over £25,000, which are led by TfL procurement, staff are not required to sign an assurance that they do or do not have an interest in any contract or grant funding below the £25,000 threshold. As a result of the audit, it's been agreed that staff will now sign an assurance that they do or do not have an interest in any contract or grant funding at the start of the procurement process for all procurements.
Thank you very much. I suppose the one point that I want to pick up is this has been a bit of a theme, I think, over the last couple of meetings, of mandatory training that turns out to be completed by only a minority of staff, which is a curious implementation of the word mandatory to my mind. So I don't know, where does it sit to make sure that mandatory training actually happens?
So, as Mark says, as part of the governance steering group, which I chair, we've established a subgroup which is going to wrestle with, I guess, the dilemma we have where there's perhaps been a tendency to add more and more mandatory training, so the list has become perhaps a little bit too unwieldy, or it's perhaps the expectations that everybody across the organisation is going to complete all of those. So there's a look at rationalising that, or essentially justifying it being mandatory, because alongside that, as you, I think you imply, Chair, we will then enforce the mandatory training. So rather than the very low and unacceptable level of responses we've had, it's not only seen to be a reasonable list of things that which are absolutely essential, rather than perhaps some of those items might be desirable. At the same time, we can then genuinely push hard to get that compliance up to a more acceptable level. So that subgroup is reporting back to the governance steering group in April. where we would look then to define that and then think around how the processes of enforcement would then take place. But essentially, the route would be, I think, as Mark's report suggests, is obviously ultimately through our performance management mechanisms and the performance review process that will start in the summer.
Okay, so I suppose then where we see this mandatory training with low take-up, that's a sort of crunch between somebody somewhere saying it's mandatory and somebody else sort of curling their lip at it and going, well, it probably isn't really, and that low take-up is people ad hoc deciding that it's probably not important for them. So I welcome this review and rationalisation. Who is it that's been deciding that things are mandatory?
Well, I think that's part of the problem. Is it's been more of a accretion of more and more things over a longer period of time. Some of which are perhaps have lost about their sell-by date, to be frank, and actually it hasn't been looked at in a very sort of rational framework, as I tried to describe, alongside genuinely wanting to enforce it. So, I think it's just getting real about the process as well, because I suspect the things are in there that actually, yes, they would be certainly desirable, and people obviously should still complete those desirable elements, as against things that actually, if you do not complete, will then lead to that being raised in your performance review.
So does that fundamentally sit with HR?
HR are part of this subgroup we've established, but the subgroup, Emma may recall that subgroup, but it certainly includes Mary Harpley. I think it also includes people from within IT also around ensuring we have the technology to do it through. It may also include some others who I can't honestly remember at the moment, but it's a fairly significant subgroup of the governance steering group.
I suppose, while I welcome that initiative, I just slightly worry that it doesn't, when I ask who owns it, because that means that's the person whose job is to make sure that it happens, and partly the reason we end up in this situation is because nobody really owns it, and so nobody really has to account for it.
I think it's very clear that our chief officer has taken ownership of this as a subgroup, and then to then report back to full governance steering group, which I chair. So, I think it's got the kind of highest level of attention that it really could get.
Well, that sounds great. Did anybody? Yes, Kripesh.
Just out of interest, because I couldn't see it in the paperwork, is how big is the mandatory list? So what number are we talking about in terms of volume?
Emma may know
it's quite long. I'll be honest. And I think, coming back to the point of who's responsible, I think there's a question as to how do we set that list and what's a reasonable list? Should that list apply to all staff in the same way? People do very different jobs. And then how do we ensure that process is followed up? Now, there's obviously the line manager has a responsibility there, and it seems to me that I'm aware there's been discussions about in things like induction processes, and as part of that induction process and as part of probation processes, one could reasonably assume that as part of signing off a new member of staff's probation, they would have finished that mandatory training, and that mandatory training would be a requirement for that role. There's obviously things in there which are really important for all staff, like health and safety training. There are other things like, perhaps procurement is an example where not all officers of the GLA get involved in procurement processes. So that might be mandatory for some officers, but actually an optional piece for others. So I think that the group is looking at it. It will then set the standard, and then there's a question as to how do we ensure that enforcement both through probation processes and sort of people's ongoing personal development at the GLA, which of course is really important. These things aren't just a kind of a task you have to do, but actually something that is very useful in people doing their jobs.
Thank you. And I think for the committee's purpose, I think it would be good to get a list of what is considered mandatory at the moment, just so that we're assured really about the recommended action that is looks like it's going to take place in terms of reviewing that list, because we've got the percentage, the 32% percentage in it, and I think we just need to assure ourselves that your approach, if you like, to tackling the 32% is actually to make the volume lower. We just need to be assured of
the list. The list definitely includes things like health and safety, it includes recruitment training, it includes procurement and governance, cyber security, those kinds of things. And I think the question is how far can you get to in terms of compliance? Because of course the general turnover of staff means to get 100% compliance to everything is nigh on impossible. Yeah. But getting a higher level of completion than 32% should not be difficult.
That's absolutely fine. I think for us it's just about if it turns out the volume of whatever the list is let's say 15 versus 5, then obviously that means that we can see the validation of the judgment on the way forward.
Yeah. If I were to take a punt, it's nearer 15 than 5.
Okay.
Currently.
Okay. I'll be happy to see that list. I suppose my personal view on these things is that if you have something that is a rule, but most people think the rule is silly and therefore don't comply with it, you haven't really got a rule. And I guess the purpose of that group you've talked about is to rewrite the rule of what is actually mandatory so that there's broad agreement that it is mandatory. And I think these very low compliance figures here, we've seen it before when HR were here, I think, was it the previous meeting or the one before? Across the board, it seemed to be quite low on, in inverted commas, mandatory training. As I say, my sense is that's people reacting rationally to what they see as an irrational description of mandatoriness.
I mean, just to add, as we discussed before, we've made a huge push on getting cyber training, which is one of the mandatory elements. And despite essentially an awful lot of very vigilant work, we probably didn't get much above 90%. And that was really
good,
an
awful lot. 32.
Absolutely, but I think also as part of the work, we just need to set what would be, a realistic level of target, given the work we could do. So I think as part of that group, we also need to think about what would be a reasonable level of compliance, but also that then coming as part of the follow-up report that Mark and his team will do on this audit.
Okay, that's great. Does anyone else have any questions on the ethics? And nope. Okay, thank you very much. I think that does take us back, as it were, to the audit plan. Is that right?
Yeah, thank you, Chair.
Okay.
So what we have here is the GLA internal audit plan for 2023-24. Just as the beginning of the report sets out the audit independence that we subscribe to. So that's we follow the public sector internal audit standards, also the requirement of the Accounts and Audit Regulations 2015, the requirement to have an internal audit in place. Then the planning process that we go through, so this is a risk-based approach. So myself and the team have spoken to all the directors to understand the key risks. Obviously, we undertake and understand the work that we've previously done, so that's always factored in. And then we've got a draft plan which you have in front of you here. I don't anticipate going through each stage of that, but to highlight. Each of the directorates have work that's been identified, the quarters that work is to be undertaken in, and also the days that have been allocated. Key factors are that we've increased the contingency for fraud, and that's based on the experience that we've had primarily in the last 2 years. So we've increased the contingency. Hopefully we won't have to use that, but it's just to really identify that this is based on past experience. So I think it's prudent for us to have factored that into the plan for this year. Taking the point that was raised earlier about the LLDC review and the financial sustainability within the plan, we have the key financial systems work, and part of that is the material systems, the financial systems and key controls. I would look at potentially maybe factoring in that piece of work within that area. So there's 15 days, so that's something we can look into and look at the key controls and taking, as I say, the financial sustainability of the LLDC and the oversight, and we can maybe do that in that area of the plan. So there's already an area where I think that would potentially fit in. So we wouldn't necessarily have to add it or even take something out. I think it would maybe fit into that. I will defer to David, who obviously is that is his area, so he may have different views on that, but that's literally that's the area I think. Otherwise the plan is as set out, and I'm willing to take any questions, challenges on that, but as I say, it is a risk-based approach that we follow, which is standard for for internal audit for organisations. So yeah, willing to take any questions or
Did anyone have any questions?
Observations.
So I observe that the number of days is increasing due to emerging fraud risks. So is that just the stuff that we were speaking about earlier?
So as I say, it's really a prudent contingency within that. So that although the days have increased by, we've put in 30 days to cover that. It's based on previous experience. So it's because unfortunately, David, that it's been an addition, sort of payment, and once you get into a fraud situation, that the time taken to investigate, unfortunately, is something if we can avoid through better controls, whatever, we would like to do. However, I think it was prudent to add that in because obviously it helps David and from the team perspective to budget accordingly. That that's something might need to call on through the year. So that's why the days have increased. However, I'd like to anticipate that they won't be used.
Okay, just a bit of cushion.
Yeah,
hopefully.
That's what we hope.
Okay, were you itching to say something, David Galley, or not? Sorry, I couldn't quite tell.
Well, I guess only on the material systems, I guess I'm always kind of quite loath to move audit resource away from looking at payroll and payments, those core systems, but obviously happy to look at with David about how we can try and balance that out, or potentially use the contingency, or as in the audit plan you'll see there's also, I think, some scope for income generation around grant claims, where colleagues are auditing external funded grant claims, which I think could be something that could be charged. So I think there's scope within the plan to be able to take forward, Nick's important suggestion.
Just one further thing on that. It needs to be. This is an indicative plan, so it will be, subject if the risk profile of the organisation changes, and bearing in mind what David's just said, we'll flex that, and obviously any changes we will bring to the panel to describe what's been required, and if that risk profile's changed, and why something's been pulled out of the plan and added in. So that's something we will also do as well.
Okay. I mean, on that point actually, about how it adapts and evolves over the course of the year, something that was flagged up that it says that suggested changes will be subject to the approval of the Executive Director of Resources and the Audit Panel. Is that a change from just approved by the Audit Panel in consultation with the Executive Director of Resources? I'm not sure if that was a deliberate change or just a accidental change of something. I wasn't sure whether there was something going on there, that there was a fear that the audit panel might run rampant and need reining in by the Executive Director of Resources.
No, no, not at all. No, we obviously have taken the point I've just made about the it's a risk-based approach. So we would bring it to the panel to get your approval that we are changing the plan. So that was the idea there, and obviously we work closely with David, and David has been very good in helping to maintain and we retain our independence through the work that we undertake. So I think that's from our perspective, it's a healthy relationship.
And very much, I'd want the panel to be able to shape and influence, because you need to have that degree of oversight. And also around just reporting transparently to you where there has been a change. So I think there's anything sinister in that wording, but I think I'm wanting to have the genuinely open dialogue around trying to shape the plan to best use of public money.
Fair enough, that sounds fine. I don't think there were any other questions on that item, which I think then takes us to the investigation suspected theft of IT equipment exempt item. I don't know whether... If nobody particularly, because I know we've seen the briefing, I don't know that anybody has any questions on it. It may be that we don't need to go into that in any detail at all. Okay, lots of shaking heads. In that case, I think we'll probably be able to avoid going into an exempt session to cover that item later on, which brings us, I think, to the end of that item. So can I ask the panel to note the contents of the internal audit reports attached to the report as appendices 1 to 6, and I'll take that silence as overwhelming agreement. And so if we return, we don't need to return to Appendix 7, so that brings us to Item 7, which is the monitoring of expenses and taxable benefits incurred by the Mayor, London Assembly members and senior staff during the period of April 2022 to January 2023, for which we are joined by Emma Strain, the monitoring officer. Is that right? Oh, that's the next item.
That's the next bit. David's expenses are there.
Sorry, we're still here. Yes. So who is it? David Galley, are you?
Yeah, it's just really whether the panel have any questions, wanting further information on any of those declared expenses.
Did you have a question?
Yeah. Just one question. I'm not going to expect to have this information now, but perhaps you could write to me. Under Mayor and Assembly members, there are two sums noted for other domestic travel, one of £936, one of 110. Would you just be able to write to me with the details of what those trips were, what the modes of transport were, what the reasons for the trips were, etc., that sort of information?
Happy to do so.
Lovely, thank you.
Okay, so if we note the taxable benefits and expenses incurred by the Mayor, London Assembly members and senior staff during period April 2022 to January 2023, we could note those. Lots of noting. Excellent. That takes us to item 8, the corporate risk register, where we are joined by David Galley, or we remain joined by David Galley, who's the Executive Director of Resources at the GLA. Just as a note, obviously there are potentially some exempt items within this, so people just want to be aware of that. We probably don't want to have to go into an exempt session, but if we do, we would probably need to come back to that. So, did anyone have any questions on the corporate risk register? Okay, so can I ask the panel to note the corporate risk register and identify any points it wishes officers to consider ahead of its next 6-monthly refresh and update? And can we also note the refreshed risk management framework and identify any points we wish officers to consider ahead of its next policy review? Excellent, lots of nodding. So we now move to item 9, the annual report of the monitoring officer regarding complaints against elected members. And for this item, we are joined by Emma Strain, correctly this time. Welcome, Emma.
Thank you.
Does anyone have any questions to the monitoring officer on item 9? No, well, I apologise for the brevity, or congratulate ourselves on the brevity. So can I ask the panel to note the report?
Noted.
That brings us to item 10, Register of Gifts and Hospitality, the Mayor of London and London Assembly members. There was an incorrect, just for information, there was an incorrect, when the documents were initially published, incorrect report that was circulated, but a correct report has now been circulated. So can I ask the panel to note that updated and corrected version? Noted. Excellent. Item 11, Register of Gifts and Hospitality members of staff. Can I ask members of the panel to note the report? Okay. And item 12, the Audit Panel Work Programme. Can I ask the panel to note the panel's work programme? Excellent. Noted. And finally, we come to date of next meeting. The next scheduled meeting of the audit panel will be confirmed at the London Assembly's annual meeting of the 4th of May, since this is the end of this civic year. I have not been notified of any other urgent business, but I would just like, if I may self-indulgently, thank not only the members of the panel, but in particular the members of the scrutiny team and the members of the committee services team who have done a great deal of unnoticed work in the background to allow these meetings to take place, plus of course our regular panel of guests who are here each time. So on that note, I think we will bring the meeting to a close and thank everyone. Thank you.